Good afternoon and welcome to Leveling Up with HYCM. This is our online trading workshop provided for you by HYCM with myself, Giles Coughlin, a currency analyst. I'm going to be looking at how to apply some of the practical skills we've been looking at and how to put them all together into 1 hour of live trading and background. So I'm just going to give a welcome to people as they're arriving. Let's just see who we've got coming in. Hi, Emily, again. Nice to see you. Samuel, Van, Zhang, Hashik, Rico, welcome back, guys. It's good to have you here. Don't forget, we've got the question panel as well. As people are arriving, don't forget to ask questions as we're going along. Just start with a quick disclaimer before we get into it. And this is just making clear, and it's particularly important for this workshop, is as we'll be looking at the charts and different trade ideas, none of this is trading advice. The idea is that this is education. It is designed to help you engage yourself with the markets, and so you can understand how to apply these principles and put them into practice. It's for your education. It's not for trading advice for you to use this as a signal service or anything like that, just to make it clear. And also it's helpful for you in terms of your expectations, what you should be doing and how you should be approaching this workshop. You want to be working on your own skills to develop yourself as a trader, so you don't need someone like me. That's the idea. That's what I'm trying to impart to you, a knowledge, and set you on the right course. So to that end, I've provided a handout for you. Just if you look on the right hand panel of your GoToWebinar control panel, you'll see a little triangle that is presented by the word handouts, and it should say 1 of 5. And if you go there and just click on that, you should see a workshop guide. Okay, it's entitled Workshop Guide 3rd of December. Have you all got that, guys? Can you all see that handout? And once you click on it, it should open and it should look a little bit like this. Okay, so that's the handout that we have for this session. The handouts are designed to be the same, to keep it consistent for you, so you can start to put down principles of how to approach the market each and every time. The distinctive that we're going to be looking at with this workshop is, let me just open that up for you again. The distinctive is looking at Brexit. We're looking at the Brexit situation. Okay, so we've been looking at that in particular, and let me just bring that across for you. Just looking there, there it is. We're looking at a special Brexit focus, trading the pound in the run-up to the UK's Parliament vote on December the 11th. The pound is at a really crucial moment, so we're going to have a special focus during this webinar looking at Brexit, where things are, how things are going in the UK Parliament, and what that means for the pound. So that's going to be the special distinctive for this session, so just be aware of that. We'll be looking at that after our normal workshop issues that we'll be looking at. So make sure you've got that workshop guide open. You'll be needing to refer to it, and also please make sure that you have your demo trading accounts open as well, so that you can be looking at the charts as we come to spotting and looking for good potential entries when we've discovered what is a good currency pair for us to look at trading today. So that's, make sure you got those couple of things open. Yeah, just a few more guys coming in. Just hi Nadir, hi Williams, Zhang, Ahmed. Yeah, good to have you. Nice to have you here with us. The next yeah, the handout, we've covered that, so make sure you have that. Also, make sure, don't forget this service that you have, which is you can email suggestions for topics that you want covered to us here at workshop@hycm.com. So if there's something that's really interesting for you, you can just email us that, and we can cover a topic. I'm really, want to help you guys. Remember that the idea of this is education. The idea is to help you understand the market. So if there's a gap, or there's something that's missing in your trading education that you really want to see covered, just email us at workshop@hycm.com, and we can try and provide a special distinctive going forward that covers that topic. So make sure you do that. Okay, so the first thing you need to do is have your handouts open. So if you want to go to your workshop guide and open it up, we're going to be looking at our first aspect as we look, and that is the workshop should look like this, and we're going to be looking back. But before we do, there's one more thing that I have to remind you of, and that is the raffle. Last week we had our first raffle drawn, and the raffle is drawn to choose one person who's a winner for a one-to-one trading session with myself. And we had our first winner last week. So this month we're doing the same promotion, that one person who attends this workshop live, you have to attend it live, will be entered into the raffle for the end of the month draw. So you guys who are here listening to me live, well done. You are in the raffle for this next month. And that is something that's good news for you guys. And if you're listening to this recorded, don't forget that if you attend these workshops live at 1 o'clock to 2 o'clock at GMT time in the afternoon, then you will be entered into the raffle yourself as well. Okay, I'm going to ask you some questions to you as we go through this webinar as well. So make sure, I want you to come ready to answer questions. Now, let me encourage you to answer questions, because I'm not going to think any worse of you if you get the wrong answer, or you say something that you consider to be silly. Don't worry, I really want to hear from you. So please do, when I ask the questions, please do try and answer them, because it helps me get a level of where you guys are, and it also helps me understand if I'm able to communicate properly, and that what I'm teaching is being understood. So that's quite important for me. So if you could help me out and answer those questions, I'd appreciate that as well. And I will be asking questions and putting you through your paces during the session. So that's something for you to be prepared for. So you should have all turned to your handout by now. And if you've just joined us, don't forget that the handout can be found on the GoToWebinar control panel on the right-hand side of the panel. It says handouts 1 of 5, and it says workshop guide 3rd of December. Just click on that, and then your workshop guide will come like this. And these are the 1, 2, 3, 4, 5 principles that you need to look at every time you trade. Every time you're thinking of entering into the financial markets, you follow this process, and this process will save you a lot of trouble. It will also guide you out of danger, and it will help you to approach the markets in the correct and professional way, in the sense of it will, in an ordered way is what I mean. It's systematic, and it's a good principle for you to follow. So it's like, whenever you're learning a new skill, you want to follow the good principles and put a good foundation on, so that you're building in a good way. So here we go. We're turning to a handout, and the first thing we always do before we start looking at the financial markets is we have to look back. Okay, so if you look on your handout, it says identify recent sentiment by reading up on the last 2 sessions of market activity. Every time you come to your desk, you don't open your charts first. Get into the habit of coming to your desk and then identifying what is the recent market news, the sentiment that's affecting the last 2 sessions. Now remember, sentiment just basically means mood. So when you hear the word sentiment, think of mood. Okay, so we have to look at what mood is the market in. And we do this by looking at the last two sessions. So we're now just entering the US session. So you want to look back to the London and the Asian session that has just passed. Okay, so we're going to do that. And then we're going to start to try to identify what that sentiment is in a sentence or two. You want to try to summarize it for yourself so it's something you can communicate and understand. So here we go. So first of all, let's look here at the Asian session. Okay, so the key data that came out of the Asian session was that the Reserve Bank of Australia had their rate statement. Now, it was widely expected that the Reserve Bank of Australia would keep their interest rates unchanged at 1.5%. And that is exactly what they've done, unchanged at 1.5%. And you can go onto the Reserve Bank of Australia's central bank website and you can read Governor Lowe's statement there on the website. I suggest you do it. And these are just some of the highlights from that statement. He was saying that the low interest rates are supporting the economy, that they have made progress on unemployment, expecting inflation to rise gradually. We'll come back to that in a moment. Expecting GDP growth to average about 3.5% over 2 years. Noticing that the housing markets have slowed in Sydney, Melbourne. That is a cause of concern for the Australian economy. Also, uncertainty outlook for the household consumption. There's been a growth in household income that's remaining low. The debt levels are high. That's a concern, consumer debt levels. And they're saying that the central case for inflation is 2.25% in 2019, but they think it's going a bit higher in 2020. Okay, we'll come back to that in a moment. And, you know, wage growth is picked up, likely to be gradual. They've got Australian dollar remaining at the range. So the basic news is there's nothing particularly new coming out of Australia. There was a sense, a little bit of a bullish Australian dollar reaction by the market, but there isn't anything particularly, you know, of real marked interest here, aside from one interesting thing, which is this phrase here. They saw a central scenario for inflation to increase to 2.25% in 2019. And there was some market data out last week. They were saying that the CPI inflation was 1.9%, and in underlying terms, inflation was 1.75%. Okay, so they say inflation is expected to pick up over the next couple of years, with the pickup likely to be gradual. The central scenario is for inflation to be 2.25% in 2019 and a bit higher in the following year. Now, when you look at the private sector survey for core inflation, that came in at 1.3% year on year. Okay, so the core inflation, remember, that's the real most important measure of inflation. It's what's the core inflation that isn't affected by some of the fluctuating things that tend to fluctuate in price more, is only a core rise of 1.3%. Okay, so that's quite a big jump that the Reserve Bank of Australia were expecting, 2.25% in 2019, where here we are end of 2018 and it caused 1.3% year on year. So that's just, you know, nothing that's tradable as such, but just, you know, you want to mark those kind of divergence in the data versus the central bank's perception of itself. That's just something to note, and it might affect the Australian dollar going forward, in that inflation might be harder to come by than the Reserve Bank of Australia is expecting. And obviously, if inflation is not rising, then interest rates won't rise either. So that will weigh on the Australian dollar. So that's the line of thinking that goes in. Now, the main move last night was there was a big move in the dollar yen and the Nikkei overnight in the Asian session. Now, this was driven by the China central bank. They revalued the Chinese yuan, biggest setting since June 2017, set at 6.8939. That weighed heavily on the US dollar, Japanese yen. The moves were quite large for the Asian session. And this is the interesting note, and I'm really glad this point's come up, because last week we did a special part of this webinar was looking at bond yields. and how bond yields affect foreign exchange prices. So this is the bit where I'm going to be involving you guys, because I am going to be putting you through your paces and to see if you've done your homework or you can remember what we learned last week on bonds. Because overnight, the 10-year Treasury yields fell to their lowest level since mid-September. Okay, so I've got the 10-year US 10-year Treasury yields here, and you've got them coming in here at 2.959 is when I took this screenshot. You can see that price is down and testing the 200 exponential moving average. We saw a bearish outside bar after the 100 exponential moving average, and price moved down to test those lows. We've got it. I'll just see what we're currently at with the 10-year 10 years, and the 10 years. I've got my minus 0.7% there. So they are falling. Okay, so this is where we start to put things together. With the US 10-year Treasury yields falling, what does that mean is happening to the price of the bond? Okay, this is where I'm going to ask you guys. Okay, so if the Treasury yield is falling, what is happening to the price of the bond? If you can remember last week, we looked at bonds and their price and their yield. So if the yield of the bond is falling, what's happening to the price? What do you think? And thank you, Tribuvan. Thank you, Tribuvan. So we have yields of the price falling, which means the price of the bond goes up. Thank you, Nadir. Okay, so the price of the yield is falling, so the price of the bond goes up. Okay, have you all got that connection? So when yields are falling, the price of the bond is rising. Okay, so try and get that into your head about bonds. Falling yields mean rising prices of the bonds. Yeah, that's okay. That's good. Well done, Tribuvan. This is how we learn. Okay, so you might want to take a screenshot of this. Okay, to help you remember for the future. There will be an opportunity to look at this. If you want to take a screenshot, quick, I'll give you a chance to grab one now. So falling yields is rising bond prices. Now, next question for you guys. Thank you very much, Tribuvan and Nadir, for answering the question. That's great work, you two. So, if the bond price is rising, what is that saying about interest rates? So we've just established that the yield is falling, the price of the bond is rising. So if the price of the bond is rising, what is that saying about interest rates? Because there's a correlation between the two. Nadir, that's exactly right. Give someone else a chance to answer. So if the bond price is rising, what is happening to the interest rate? Thank you, Samuel. Thank you, Tribuvan. Thank you, Nadir. Thank you, Diep. Well done, guys. Very good. Right. Okay. So this is what happens. Those guys who got it right, well done. Those guys who answered, well done. When the bond price rises, that means that interest rates are falling. Because remember, interest rates and fixed rate bonds move in opposite directions. Okay, so what we're having a rising bond price, which means falling interest rates. You got that, guys? Have another screenshot at that. This shows the relationship. So when bond prices are up, interest rates are down. All right? Now, when you look at this again, you will see, okay? So here we go. If yields are falling, it means prices are rising and interest rates are falling. Yeah? And this is exactly the scenario that we have at the moment. Look at the bottom of the screen. If yields are falling, like here, then the bond price is rising, which is saying that US interest rates are expected to be falling, right? So that if you're like, if you're struggling with bonds, it is tricky at first. So don't worry if you're finding it hard or confusing. You just need to sit down and spend like half an hour looking at it, and then keeping a little crib sheet by your desk to help remind you, and then it will become intuitive after a period of time. It will just become obvious to you. But at first it isn't. It's just one of those tricky things, okay? But here's a little way to help you, okay? So when you're looking at treasury yields, like here is the 10-year treasury yield, it's 2.99, down 0.7% on the day, okay? So I've got the yield is falling, okay? So look at this. If yields are falling, then interest rates are falling. If yields are rising, then interest rates are rising. That is a quick way of understanding it, okay? So the quick way of understanding it, if you've got yields falling, interest rates will fall. If you've got interest rates rising, you've got yields rising means interest rates are rising, okay? So do you start to see why the market is concerned about these 10-year treasury yields falling? Okay, it's indicating that the market's expecting interest rates to fall as well out of the US. Okay, and there was one very important factor that got the market's attention in the Asian and the London session, and it's been a big driver all morning. And it's basically this. It's basically something that's been reported about all year. And again, bonds can be quite tricky at first, so don't worry if you don't get it. But I'm really pleased that this has come up just 1 week after we looked at bonds, because this is having a big impact on the FX markets. And what we need to look at here is the difference between the 2- and 5-year treasuries, okay? And what's happened is there's been an inversion in the treasury yields here. You got them falling below zero. Okay, now the significance, and this is something the market's been talking about for a long time, is that when this phenomena happens, then typically it signals a recession. Okay, so the last time this happened, it signaled a recession down here. Okay, so what the controversy is people are saying, okay, look at, they've been talking about the flattening of this yield curve. Now it's gone below zero. And so the big question is this signaling a recession for the US? Okay, that would obviously be very significant news. And typically, historically, it has done. Okay, this phenomena has signaled a recession. So the question that the market is now asking is, shall the US be on the verge of another recession? Is that what's about to happen? Now, the Federal Reserve, some board members have been talking about this yield curve, and some of them have been saying that actually we're in quite a unique scenario now, what with quantitative easing and the different approaches of that the central banks have been taking, means that maybe, possibly, this inversion, this signal, won't necessarily signal a recession in this instance. Okay, but remember, a lot of people are thinking it does, and it certainly has done in the past. So what you need to be aware of is of that question. Now, whether it will signal a recession or whether it won't signal a recession, no one knows for sure. So what the market is saying is it looks like it might be, or it could be, or there's the way the market works, it's the fear that it might be often can drive price. The reality might be different, but even the expectation. So that kind of sentiment has been entering the market. Think about it. Is the US on the verge of another recession? Yields falling, which means US interest rates are likely to fall, are going to fall as well. So the market is looking at a more dovish outlook for the Federal Reserve. We had the FOMC out, on their last rate statement. Jerome Powell, the chairman, was more dovish about the state of the US economy. He said we're going to be more data dependent going forward. Okay, so these are the questions that are starting to weigh on the market, and a lot of the market has been long US dollar. Okay, now there's reason not to keep being long on the US dollar, and these US 10-year Treasury yields are signaling that. Okay, so this is coming into the London session, that's weighing on the market. Now, there was some other significant news as well. And the other significant news came up, which was saying that the European Union Court has ruled that Britain can revoke Article 50 unilaterally. Okay, so Article 50 is basically the Brexit trigger for Britain to remove itself from the European Union. Okay, so what the EU court has said is that Britain can cancel Brexit unilaterally, in other words, on their own. So they don't need the agreement of the 27 other countries if they want to halt Brexit. Okay, so that had a a bullish impact on the pound. Now, this is a very good example of something as well, because what it's been saying is that Britain, the market reacts sometimes in a very knee-jerk way. So the EU has says that if Britain wants to remain in the EU, all it has to do is say it wants to remain in the EU, and it can. Okay, so the market's bought the pound because in one sense that's good news for the pound. But does that really change anything? Well, the answer is no, it doesn't really change anything. Okay, it's nice to know. It means that if Britain suddenly decided that they did want to not leave Europe, it's a relatively straightforward process. So that is what the market is reacting to, that hint of some kind of hope of a deal, of everything being washed away, and it's like Brexit didn't happen, so the market reacts. But fundamentally, that is not going to change really what's going on in Britain. And in fact, not long after this statement was out, there was a few data points out on Reuters. I was looking at the terminal at the time, and they were saying a UK Prime Minister spokesman was saying that Britain won't be taking this option. Okay, so Britain won't be revoking Article 50. It's got no intention of doing it whatsoever, which is what we knew anyway. We always knew that was the case. However, that is just so. This was an opportunity where I shorted the pound yen. We'll come into reasons why, but I use this opportunity of good news to sell the pound, because I'm looking at selling the pound, but I'm looking at selling it from a decent price. Okay, so I use this good news on the sentiment, and that's called fading sentiment. Okay, so fading sentiment is when you do the opposite to what the latest news is doing. Okay, now this isn't trading advice, and it's too late for you to get into that trade now anyway, but I just wanted to let you know that little learning point, how to fade sentiment. Sometimes when there's good news, you end up selling that good news because it doesn't change the picture. Do you understand that, guys? You see, so the big picture is EU court rules that Britain can revoke Article 50. Good news, pound gets bought, but actually it doesn't really change anything. Britain's still going to carry on the same path it is, and that is likely to be faded, that kind of sentiment. Now, as we move forward, there was also some headlines out for Italy, and the Italian situation is interesting as well at the moment. And the interesting thing out of Italy is that the Deputy Prime Minister Salvini says that the 2% budget deficit is just a number. Okay, so in other words, what's been happening here with the Italian government is the Italian government were voted in. They said to the people, we're going to give you these pay increases for various social projects they wanted to do. Everyone in Italy says, hooray. The EU says, oh, but you're going to have to run your budget at a 2.4% deficit in order to do this. That's not good. Why don't you change your budget? Italy have said, no way, we're going to do what the Italian people want. We don't care what you think. And the EU has said, well, that's a big problem. And so there's been an antagonistic relationship between Italy and the EU. That has now changed. Okay, so Italy is now a lot more cooperative with the EU, and they're trying to work together at a solution. That's a genuine shift, and you can sort of see that even in that latest headlines. This problem isn't going to go away. Okay, it isn't going to go away, but it's just to be aware of it that it's Italy's economy minister Giovanni Tria has said that Italy needs to avoid EU procedures. Okay, so in other words, he's saying, we're not wanting to upset the EU, and the EU, in a similar vein, have been saying, we want to talk with Italy, and they're sort of cozying up a bit closer together. So that's just to be aware of those latest headlines, because this is a significant market moving situation, and it has been and is likely to be, but that situation is easing a little bit. Okay, we also had some OPEC headlines. OPEC are meeting on December the 6th, and they've been talking about production cuts, and they're looking at about 1.3 million barrels per day production cut. Now, that's the upper end of estimates, and oil has found some bids on the headline. I was wanting to buy oil this week on the basis of the G20 meeting between Putin and the Saudi prince, when Russia and Saudi Arabia have essentially, were indicating that they're very warm and looking forward to, not looking forward to rather, but they're open to production cuts. So the oil was always going to be bid on the back of those kind of headlines. And now we've got production cuts looking at around 1.3 million barrels per day. OPEC chairman came out and said, well, we don't know what levels we're doing, but, bottom line is it's looking good. So that's just to be aware of that. And obviously, here's a question for you guys. Which currency is most affected by oil prices? Okay. Which currency is most affected by oil prices, and which currency pair has a 96% correlation with the price of oil? I'll give you. Yeah, brilliant, guys, you're on fire. I've had 3 answers, all correct. Tribhuvan, Nadir, yeah, brilliant. Okay, that's exactly right. So even if you don't trade oil, you want to have a look at oil prices. Whenever you're thinking of trading the Canadian dollar, always look at oil. You must. And if you're not aware of what's happening in the oil markets, you shouldn't be trading the Canadian dollar, because it's just, you don't know whether you're doing the right thing or the wrong thing. You just need to be looking at that. Okay, so guys, 3. Tribhuvan, oh yeah, that's good. Yes, well done, guys, brilliant. There's so many right answers there. For the guy who said it dollar yen, no, it's not dollar yen, it's dollar CAD. Dollar CAD has a 96% correlation with oil prices. Okay, so be aware of that. And CAD is affected by oil prices. Get that correlation deep in your head. Okay, very good. Good work, gang. So some of you are on fire today. You got that out nice and well. Very good. The equity news, we need to see what's happening in the equity markets. The Nasdaq and the Dow and the S&P 500, they were all up yesterday, and they were up 1.5%, 1.13 and 1.09%. Can anyone tell me why were the US equity markets up yesterday? Can anyone tell me? This is for an extra goal point. What was it that was impacting the markets yesterday in a very strong way? Give me a moment. Okay, it was the US-China trade truce. Okay, yeah, President Trump and Chinese Premier Xi met at G20, and they have agreed to have a trade truce. Okay, that trade truce has meant that US equities were bid and were bought on the back of that good news. But that good kind of reaction didn't go into the overnight Nikkei Japanese equity index. And the Nikkei closed down 2.39%, which is a very large fall. Okay, that's a big. Anytime you see an equity market fall by about 1%, you want to pay attention to it. Okay, and I've got the FTSE is currently at 0.5 minus 0.54%. This was, I prepared this earlier. It was 0.73. And we've got the S&P 500 futures. I've got them at minus 0.21%. Okay, so a little bit of that is not coming into the markets Sorry, what I'm saying is that is impacting the markets heavily now. Okay, we've got quite a strong risk-off environment, and we've got US dollar weakness on the back of those rising 10-year Treasury yields. Okay, so now we have a little question for you. Okay, my question for you is, in a risk-off environment, what currency would we sort of expect to see? What currencies would we expect to see being bought in a risk-off environment? What currencies would we expect to see being bought in a risk-off environment? Have a look. Have a look. Okay. Well, one of the currencies we see Japanese yen, Swiss franc, and to a lesser extent, the US dollar. Okay. So when we look at the strongest currencies at the moment, we see the strongest currencies just after I opened this, as I was preparing to enter the US session, we had Japanese yen, British pound, pounds being sold off a little at the moment. I can just see that my pound yen position is coming into a nice profit. I'm nearly at take profit. And New Zealand dollars being bid, Swiss franc being bid, not as much as the yen, but the big performer has, and the big takeaway here, guys, is we got a large Japanese yen bid. Okay, so the market is feeling in a very risk-off environment, and we also see US dollar weakness across the board. Okay. Right, do you see now how Samuel, Swiss franc, Japanese yen, that's a good pair to trade in a risk-off environment. Swiss franc, Japanese yen. Swiss franc tends to, outperform the Japanese yen, so that's not a bad little pair to be looking at. Okay, guys, so we have now done our looking back. Okay, that's the first part of what we should do. The second part is to look forward. I want to look for key upcoming market events. Is there an anticipated event coming up? Often the market will get into a pause frame of mind. Okay, so if there's a key event about to come up, the market will often pause. And the reason it'll be pausing, it'll be waiting before it initiates a position. Okay, it'll be thinking, "Ooh, hang on, I don't want to initiate a new position yet because there's a key event coming up." So that's why you have to be aware of those kind of scenarios, key events. You never want to just start trading without looking at a key event or seeing what it is. Okay, so we always want to make sure that you do that. That's it. There we go, just closing out my pound yen positions. I want to just take that profit now and get that done. If there's time, I might show you what I did there because it's good for you guys to see as well. In terms of events that are forward, we got US voting Fed member Williams speaking at 3 GMT this afternoon. So that could potentially impact the US dollar. It's always, whenever a voting member of the Fed is speaking, you need to pay attention potentially to that as it could alter and affect the market. Now, we've looked back, we've looked forward, we've seen there's not much coming up. We just got one Fed speaker. And now we look at the charts. Right. Okay, so guys, looking at what we have with the last two sessions, we need to develop a bias for certain currencies, okay, based on your sentiment analysis, right? And what currencies would you be looking at trading given the information that we've been looking at? Okay, and what we do, we want to pair up weak and strong currencies. So which currencies are strong at the moment? Right, which currencies are strong at the moment? Right, I'll give you a clue. Okay, which currencies are strong at the moment? Yeah, we have got some euro strength. We have got some CAD strength on the oil being bid. Yeah, that's true. Williams, I think that's a very good answer, Williams. We have strong Japanese yen and we have weak US dollar. You can see that these currencies are paired with the base US dollar. So all these currencies are appreciating against the US dollar. Okay, so Williams has hit the nail on the head. We've got strong Japanese yen and a weak US dollar. Because remember what we've just been learning, guys, and what we've been seeing is that, you know, if yields are falling and the bond price is rising, which means that US interest rates are expected to be falling. So if US interest rates are expected to be falling, and that's what these 10-year Treasury yields falling is telling us, then we should expect to see dollar weakness across the board. And people are asking, is the US on the verge of another recession? So we are seeing a significant dollar weakness across the board. Now, let's just look at the dollar index. The dollar index is minus 0.55%. Okay, so what other currency is very strong? What other currency is strong at the moment? Even just looking at this chart. Yeah, the Australian dollar has got some strength as well at the moment. Samuel? I'm thinking of something that's had a news catalyst. What's had a news catalyst? Yeah, Nadir, pound. That's exactly what I was thinking of. Okay, so we've had some pound strength. Yeah, Tribhuvan, excellent. Okay, so this is what you start to do now. Look at this bit here. Pair up weak and strong currencies. So your weak currency, we've got a weak US dollar. So a strong currency, we've got Japanese yen. Okay, so very simple trade now is to pair a weak and a strong currency together. So if we have weak US dollar and strong Japanese yen, that would make sense for us to trade the US dollar Japanese yen pair. Okay, we want to look at the US dollar Japanese yen pair. And now that we've done that, we want to then look at the charts. Okay, it's only now that we look at the charts. And as we go to the charts, we want to look at the US dollar Japanese yen pair. Okay, so let's find the US dollar Japanese yen pair. Here we go. And we go to the daily chart. Okay, and this is what we can see. We can see that this is exactly what we expected. We're seeing weak US dollar, we're seeing strong Japanese yen. We know the fundamental reasons for this. It's the falling Treasury yields. So we'll have a quick look at Treasury yields. But I'll just have a look on my other screen. Just having a look now to see where Treasury yields at, so that we keep a up-to-date US Treasury yields. Yet, so those yields are still falling. So what we want to do is we want to be looking at a US dollar Japanese yen short. Okay, so now we want to look at some sensible places to be trading this. And now in the comments, guys. Okay, yeah, you get information about Treasury yields. You need to find a source that gives you those prices. US 10 Treasury yields. So TradingView will give you those prices if you can't find it. Okay. Is this what? Yeah, the webinar is available after the session. So now let's look at this fall. Okay, let's look at this overnight fall. So here we had 4th of December. So going from this fall today. Now we've drawn a Fibonacci retracement from the top of last night's prices to the bottom of prices today. Where do you think would be a good place to look to short the US dollar Japanese yen pair today? Where will be a good place for us to short it? Have an answer in the questions. Okay, Nadir, I like your thinking. The 61.8 region. So someone has highlighted this region as a good place to short the US dollar Japanese yen. Yeah, I like it a lot. I like that as a good place to short it because we have some horizontal support. We have a horizontal support level around this area. We also have, it's about the 200 exponential moving average. That is not a bad place to short it from at all. I quite like it. Where else would be a good place to short the US dollar Japanese yen pair from? $50 fib retracement. Let's have a look. So the 50 fib retracement level, yes, that's a nice region as well. I like that. Where else have we got? Above 50, 103.50. Yeah, now the interesting thing about 113.50 is up here we have a pivot point. Okay, we have a pivot point at this region here. Now let me show you. I think I just pulled this down onto the screen for you. Let's have a look. Yes, here it is. So you see here, this is a pivot point. 113.50 is the daily pivot point, okay, for the dollar yen pair. So a nice place, what we're looking for, we want to look for a place where you can limit and define your risk. We want to use as least risk as possible. We want to find the highest probability of our trade working out, and we want to find an area that has, you know, multiple technical reasons to get short. So if you look at this, my personal preference on this would be 113.50, just around that level here. I think that would be a very nice level to looking to get short. I'd also be looking on the hourly chart. I'd be looking at the 100 and the 200 exponential moving average as they converge with the 61.8% retracement level. And your stops in this instance is you could have a stop above these highs and you'd be targeting back down to the 23.6 Fibonacci level. Or you could look at wait for price to get up to this 113.50 level, set your alarms, and use a website or use a service where you can set your trade alarm and then look at entering a short there. So if we were going to enter a short here, I'd simply put my orders in like this, pending order. I would sell limit 113 point. I think I just went just underneath that pivot point. I put my stop above the high, 113.68. I'll adjust that in the minute, and so so that's my entrance. I put my stop just above there. Allow for the spread, and what I'd be looking at doing is I would be looking at taking profit around 100. Just at 113.05, just above that big round number, 113.05. Okay, so that would be, I'll go a little bit further down. That would be what I'd be looking at there. Okay, this makes sense. You see, the problem is if you do the 50 retracement level, yes, that is the right area to go in, but then you're looking at quite a high stop above this high. And then, is your risk reward making sense? And how sure are you that this is going to carry on going down? So that's my only concern, Chib, with the 50% fib retracement level. This is not a bad level up here, because you know you've got the support of that daily pivot point. Okay, the other area is the 61.8 level there. Okay, that will be good. And one trick you've got, what you can do is, as if price retraces up to this high and you get triggered in, okay, and say price carries on going up. If price carries on going up to there and then falls again, you can then bring your stop above the last high. That's a way of reducing the risk on your stop. Okay, so that's a couple of tricks that you can do. Again, this is not trading advice. It is just for your education. But what you should be seeing here is we're putting together a fundamental picture. And we know there's important reasons why the US dollar is weak. And we know there's important reasons why the Japanese yen is strong. Okay, so this helps us develop conviction in our trades, because one of the troubles you have, particularly when you're a beginner trader, is you won't have conviction in your trades. Okay, you won't be able to have conviction. So I'll show you the trade that I've just taken on the pound yen on my for my fund, and it was pound yen. I'll talk you through it briefly. It was basically where is it? Let's get rid of that fib retracement level. It was basically this spike up to the, sorry, it was on the 15th. No, it wasn't. It was a spike up to the 50 exponential moving average. You had the rejections. I entered just around this level here, put my stop above the high, and I've just taken profit down about 114.20. And the first pivot point came in, I think, at 114.18. Yeah, so that was kind of, yeah, so it's just, it's just hit that pivot point, which was my first target, because I was on here with you guys, and the pound is so Brexit sensitive to headlines. I just took the profit when I was in a decent profit and wasn't going to quibble over a few points and taking my money off the table. But you see, this was fading the sentiment, because I knew that there was bullish sentiment in the pound, but I knew there was no reason for the pound to be bullish. I knew there was a lot of reason for the yen to be strong, so a pound yen made sense. There was the technical level. I could easily define my risk, stop above the high, playing down to the lows. I've taken my money and I've run, and it's that simple. And you just rinse and repeat day after day. Looking at your risk, we haven't got time to cover that now, but look back to previous webinars. I've done some special instructions on how to manage your risk. Don't risk too much. And the short answer is, if you're trading, particularly when you're beginning trading, you shouldn't use leverage. So you should only use the same amount of money that you have in your account. So if you have a $10,000 account, you should only ever trade with a mini lot of 0.10. If you have $100,000 in your account, you should only trade with a lot at a time, and you should not trade more than 4 currency pairs at a time. Okay, so you need to limit your risk. Key look at Brexit. Brexit. We are at a very key turning point. And the reason is because the UK Parliament is going to vote on December the 11th. And what they're going to vote for is they're going to vote for whether, Nigwena, have a look at this webinar. This will be addressing that question, okay? The UK Parliament is going to vote on December the 11th. And the key issue now is the UK Parliament's having 5 days of debate on whether the UK Parliament should accept Theresa May's Brexit deal. Okay, that is the key thing. Now, Theresa May's government, she only has a majority of about 13 members of Parliament. In other words, there's only 13 people that she has to take her over the amount of votes needed to get the legislation through Parliament. So only 7 Tory rebels are needed to defeat it. So just 7 people who don't like the deal, and the deal will be rejected. And at present, there's about 80 Tory MPs who have issues with the present Brexit deal. That's the latest research I read from the BBC on their political research. They've got 81 Tory MPs have big issues with the present Brexit deal. Okay, so look at this infogram. Can Theresa May get the deal through Parliament? Okay, so she needs 320 votes to get it through. Okay, there's about 90 or 80 Tory rebels who are unlikely to support Theresa May. Okay, so that takes her right down to 300. That takes that number right down. Okay, there's about 226 Tories who are very loyal and who are likely to back Theresa May. And there's about 15 Labour rebels who are likely to back Theresa May. But that still leaves her about 70 or 80 votes short. So the expectation at the moment is that Theresa May will not be able to get her deal through Parliament. It's not expected to happen. Okay. Now, as with trading, no one knows the future. Always be aware that there's no certainty, there's no definite in the trading world. Think the unexpected happens, and as a trader, you need to expect the unexpected. So you can't just short the pound now from current levels, because you might have to risk hundreds of points of volatility. The price could shoot up 400 points before it falls again. You have to be able to define and limit your risk. But no one's expecting Theresa May to get it through. So the default position, so what happens if the deal is not accepted? Okay, well, the default position is Britain will leave the EU without a deal. And if Parliament rejects Theresa May's deal on the 11th of December, there's a 21-day window for ministers to decide how it will proceed. Okay, so then there's 21 days of working out what to do next. And what you might get is either a general election, a referendum, or a negotiated no deal. Or there may be a fourth option. Theresa May might try again or get the vote through a fourth time. Okay, so in terms of what this will do to the pound, if the deal is rejected, it's pound bearish. You're looking at about a 10% drop in the pound instantly on the headline. Okay, so that's something to be aware of. Right? If there's a general election, that could very well be pound bullish, because it might mean that the Labour Party get elected, and in turn that might mean that Britain decide to not leave the EU after all. Okay, because it could become an election manifesto. It could become an election promise that we will not leave the EU. So a general election could be pound bullish. A referendum could be pound bullish, because the British people might vote, actually, on second thoughts, we want to stay. A negotiated no deal is likely to be pound bearish as well, because the EU has said we're not doing any more negotiations. So this is the outlook. The outlier is expecting bearish for the pound. So looking at that was why that level was an obvious level for me. I'm looking at shorting the pound, but you've got to be able to do it from a sensible level. So let's look at the pound US dollar. Now we've seen some US dollar weakness. So we're going to see a little bit of appreciation of the pound against the US dollar. So that's good news if we're looking to trade the pound. We want to try to get a better price. Now having a look at the charts here. Now let's have a look. Right, you can see, yeah. Okay, you can see that those higher prices just been sold off. That's what we expected. Fading sentiment. So good areas to look at shorting the pound are on the 4-hour charts. We want to look. Can you see the 100 exponential movement respected? 100 movement respected. 100 movement fell. 100 fell. Okay, so I'm interested in selling the pound from the 200 exponential moving average and the 100, 50 or 200 exponential moving average on the daily charts. Okay, so if you can get better prices going into the election on December the 11th, look for good places to sell. Okay, so that is what I'm looking at the moment. That is the places for you to highlight. So 50 exponential moving average, 100 exponential moving average, 200 exponential moving average on the daily chart. and you can just put, you see here, I was thinking of trading the pound US dollar at the time, but I was already in the pound yen, so I decided against it. But I would have just entered on the close of this candle with my stop above the high, and you can see you're playing back down and find a target like a pivot point or a big round number, or take the average, 50% of the average day range if you're intraday trading. Okay, guys, so that is that. We have done it. Don't forget, there's a special deal that HYCM are doing at the moment. If you deposit $1,500, you will get a 1-hour coaching session with myself. If you deposit $3,000 to HYCM's account, you will get a 1-hour coaching session with myself and a 1-hour trading follow-up review. And if you deposit $10,000 into your HYCM Tradings account, you will get a 2-hour coaching session with me, 1-hour trading follow-up review session, and you'll get 1 week's VIP support from me, which means you can ask me questions as you're going along through the week. Okay. The gold line is the 50, blue is the 100, and the red is the 200. Nguyen, that's exactly right. And I use the exponential moving average. It's slightly more responsive, and I prefer it particularly with big market moving headlines and a lot of volatility. I like the EMA. It's slightly quicker to react to it. Guys, thank you very much for another great session. You're welcome. I hope you've had a good session. I hope that's been helpful. Thank you for the questions you've been answering. Guys, homework for you for next week is look up on bonds. I want you, if you weren't sure on bonds, go and look them up. Spend half an hour, get your head around it, and follow the US Treasury yield story for the rest of this week. See if you can keep that up, and you can see the impact on the US dollar and how it's being impacted by the Treasury yield issues that I've highlighted during this seminar. I hope you have a good week. Don't forget that workshops are 1 p.m. GMT every Tuesday, although I won't be around next Tuesday. I'm in Dubai doing some training for some aspiring traders, so I won't be here next Tuesday, but the Tuesday after, Lord willing, I will be back. So make sure you put that in your diary. Workshops 1 p.m. GMT every Tuesday. Where do you get the webinars? I think the webinars are on the they're on the HYCM website under the education option. And if you've got any problems, Nguyen, just email support here. Just email workshop@hycm.com if you need any support or want to know where to get any extra information that we've been looking at. Guys, I hope you have a really good week. I've really enjoyed this webinar today, and I look forward to seeing you guys shortly. Okay, yeah, you're welcome, Nadir, and you, Trib. Very good. Thanks, guys. You have a great week. Bye.